Hello, everyone, and welcome to this special edition of Nomura Podcasts. I'm your host, Yuban Paracuelas, Chief Southeast Asia Economist at Nomura in Singapore, and today is the 3rd of June, 2026. This week, we are holding our flagship conference, Nomura Investment Forum Asia, or NIFA 2026, here in Singapore. So today's episode is a special edition in which we discuss key findings of our new anchor report called Asia Rewired. The report looks at several themes, 11 of them specifically, which represent structural shifts that could be transformational for Asia, like the AI revolution, trade investment realignment, de-dollarization, China Shock 2.0, to name a few. These will be all hot topics covered at various NIFA sessions, including with keynote external speakers. And in our report, we argue that this rewiring of Asia is creating winners and losers in the region, but also presenting some investment opportunities. So I'm very delighted to be joined by a few of the main authors of the report: Sonal Varma, Chief Economist for India and AEJ, Craig Chan, Head of Global FX Strategy, Jong-Woo Park, Senior Economist Korea and Taiwan, Chetan Seth, Equity Strategist, Asia ex Japan. A lot to get through, so let's dive in. Okay, great. Thanks to all of you for joining this podcast. Our anchor report, Asia Rewired, has 11 themes, each focusing on structural shifts like AI revolution, trade and investment realignment, de-dollarization, etc. And we've argued in the report that these shifts will create losers and winners in the region and some investment opportunities as well in Asia. So I think it might be good to just highlight these divergences here and draw some market implications. So Sonal, just to kick off with you, can you just give a quick overview of what you see as these structural shifts rewiring Asia and their interconnectedness?
Yeah, so I think a good description of what's happening in Asia is everything, everywhere, all at once. We're talking tariffs, trade realignment, energy security, and it's just like constant shocks. And our view is these are not random occurrences. These are interconnected events. It reflects the ongoing transition from a unipolar world to a multipolar world. So under the unipolar world, it's been a single hegemonic power, which is the US rules-based open trading system. And now, as we transition to a multipolar world, we have rise of China, great power rivalry, and trust deficit. So the end result is essentially trade and investment realignment on geopolitical lines. There's a lot of focus on self-sufficiency, on energy, critical minerals, higher defense spending, shift to alternatives to US assets, increased volatility. Plus, we have the AI revolution and China shock interacting with these shifts. So in all, Asia is getting rewired. And the last 50 to 70 years of open trading system, which led to rapid growth in Asia, is changing. And governments, firms, investors will have to adapt to these changes to stay ahead. So it does create ample opportunities for Asia.
Yeah, thanks, Sonal. That's a nice way to frame these shifts together. So let's go into the specific chapters. And obviously, AI is a big topic that we also tackle here. Jong-Woo, you led that chapter, and you have a neat matrix there classifying Asian countries in two categories for AI production versus AI adoption. So you're arguing that this classification is redrawing the growth outlook for the Asian countries. How is that?
Yeah, thanks, Yubin. Yeah, so very interesting thing is happening, with the AI revolution on the way. So previously, the Asian countries, their growth strategy is to utilize the cheap labor cost and how they can get access to markets like, for example, like China. So very huge domestic demand. But now it's after the AI revolution arrived, I think the growth strategy has shifted towards how you can join this revolution. So in terms of this changed growth strategy, we think the Asian countries now adapting to this revolution. So there are broadly two groups of the countries. One country, this group, they can provide necessary skills and products to build this huge infrastructure for AI. So we call this group AI production countries, and as you can imagine, China, Korea, Taiwan, Malaysia, those countries will benefit from this AI revolution. And the second group is that these groups, they have insufficient capacity to, join the infrastructure build, but they can, adopt AI, and later probably they can increase their productivity after they successfully adopt this AI models. So we call this group AI adoption economies. So Singapore, Japan, and the other some the ASEAN countries, they can join this group. So broadly speaking, we think that the AI production countries will get benefit directly from this AI revolution, and the AI adoption group, this country may be slowly, the benefiting from the AI revolution.
Okay, got it. That's very clear. Chetan, over to you on equity markets. Any opportunities that we talk about in the report that you want to highlight here?
Well, absolutely, Yubin. So in the equity market, there are clearly lots of opportunities that we can find from this thematic. So what we've been arguing for a while is that in many ways, Asia is really at the center of this capex-driven hardware build-out that we are seeing globally. Asia is home to companies that manufacture the essential semiconductors like logic chips, memory, servers, components, such as network switches, cables, connectors, power equipment, and many of the other picks and shovels that go into powering these data centers. So there's a long list of subsectors that are part of this AI supply chain that we think will benefit. There are even companies in Asia that are involved in the assembly, packaging, and testing of these semiconductor devices. So for equity markets per se, we think what's happening with this AI cycle and revolution is that increasingly this is really driving market leadership divergence across Asia. So just to give you a few examples, if you look at equity markets in Korea and Taiwan, they've done extremely well, as some of the main benchmark indices in these markets have a preponderance of companies that are directly exposed to this AI production theme, which JW just spoke about. These companies are particularly seeing very solid earnings momentum. If you look at the indices in, let's say, Japan and China, where we think also you can find a lot of companies that benefit from these trends, I think the index level gains are less visible because the weightage of some of these companies and indices is less concentrated, let's say, compared to Korea and Taiwan. But nonetheless, again, there are many companies that benefit from these trends. Malaysia is a similar case. That's also another beneficiary of the production thematic which JW spoke about. Again, the challenge there is that some of these companies which tend to benefit are generally on the smaller size, and therefore we do not really see the gains being reflected in benchmark indices. But nonetheless, Malaysia is home to a lot of these companies, specifically in the OSAT space. And lastly, on the other side, we have India. As JW said, AI adoption is a big theme for India. And again, our thinking is that as AI adoption gains pace in enterprises, the demand for services from system integrators like Indian IT services companies should rise. So our expectation really is that in the medium to long term, as the business models of some of these Indian IT services companies evolve from headcount driven to more outcome driven, there would be a positive change, which we think should also reflect in stock prices.
Okay, got it. So lots of opportunities still on the AI complex. Okay, shifting gears to another chapter, which is de-dollarization, and led by Craig here from the report. Craig, what makes you convinced that de-dollarization remains intact as a theme over the medium term? And particularly interesting if you see any viable alternatives to the US dollar in Asia.
Yeah, sure. Look, I think the first thing is that the fact that we do expect the dollar to weaken on a multi-month basis is already 1 point that we expect this de-dollarization theme to continue. But I would say that when we're looking at the evidence of de-dollarization, or at least a shift away from US asset allocation, it's very clear in some of the data that we've analyzed. So I would say, firstly, in terms of the portfolio allocation front, we have seen pretty strong evidence since around the second quarter of 2025, really since US Liberation Day, that there has been a pickup in bond investment into places like the Euro area, Australia, Japan in the DM space. And then in Asia, there's been some pockets of evidence as well into places like Hong Kong, even Singapore and Korea. So I'd say that's one thing which is clear evidence that this theme is continuing to build. I think it will continue ahead. The second is actually some shift in allocation into gold as well. We are seeing that in terms of very strong central bank demand for gold. We're also seeing that from the private investors as well, excluding the central banks. Even with the gold price correction that we've seen since February, it's very clear to us that demand for gold from private investors still remains actually really quite strong at this point in time. And look, I think what's important is if we're looking at the kind of the structural shift away from the dollar when we're looking at central bank FX reserves, this is a trend that's really happened since, I'd say accelerated since 2016. And I do think that, it is a long-term diversification that's happening into other currencies around the world, and something, I think will be the case over the next few years. In terms of alternatives, right? Is there really an alternative to the dollar? I think alternative is a really strong word, but I do think that there are some currencies which are benefiting on the back of this. For example, renminbi. What we have seen, for example, is that trade settlement of renminbi has continued to increase substantially since 2022, now accounting for roughly about 35% of China's total trade, up about 15% since 2022. This is a trend I think will continue. We're seeing it happening in ASEAN countries. We're seeing it in other parts of LATAM as well. It's not just about Russia. But I'd say lastly on, the alternative in terms of a safe haven, probably Singapore is the place where we've noticed a large increase in capital inflows. And I think that's to do with things like stable regulation, obviously the financial sector strength, political, social stability as well. Singapore is definitely the safe haven within the Asia space.
Yeah. Okay. Thanks. That's super interesting. Now let's try and look at other shifts which are more related to geopolitics and the interplay with economic performance in Asia. And obviously, this is a hot topic. So, Sonal, the war in Iran sharpened the focus on energy security among governments in Asia. Which countries are well placed in your mind to achieve that, and which ones could lag?
Yeah, so the war has definitely galvanized focus on energy security. So we are seeing more focus on renewables, nuclear energy. Countries are trying to source energy from outside the Middle East. There's investment in energy storage system, strategic reserves, more international cooperation. So lots going on there. Our ranking of Asia on their medium-term energy security basically shows that China is an outperformer, essentially reflecting its efforts over the years to diversify the energy supply and also its leadership in renewable and electric vehicles. The laggards are New Zealand and in Southeast Asia, Thailand, Vietnam, and Philippines, mainly because of the concentration of their energy supply partners and the heavy reliance on imported fossil fuels. I think while Asia is a net energy importer, the global push on energy security is also creating a pocket of export opportunities. For instance, China's green tech exports, solar panels from ASEAN and India, battery exports from Korea, and of course the LNG exports of Australia and Malaysia.
Yeah, okay, got it. And Joe, geopolitics is also reshaping FDI flows in Asia. So we've written that in a separate chapter as well. Can you elaborate?
Yeah, this is quite complicated issue because the previously FDI was supposed to find the lower cheap production cost, but now the motivation is shifting towards like avoiding geopolitical risk instead of the just getting cheap production cost. So now the world is the falling into three parts: the U.S., China, and the neutral part. So when you make a decision about which country you should invest in, that previously cheap production cost is the best, the solution. But now is you have to think about, in terms of the which countries are your friends, which countries are your enemy. So against this backdrop, we think that the neutral blocks like India, Singapore, Malaysia, Vietnam. So those countries are staying away from the deep geopolitical tension. So those countries will get benefit more from this the shift in the FDI flow. And at the same time, the most countries they now considering some sectors as like a key strategic industry. So even if your company wants to have like the relatively the cheap or the lower production cost, so you want, for example, like for Korea, they want to go to like a China tech companies or Taiwan, but your government wouldn't allow that. So this is also very much important, the reshaping FDI flow. And finally, the US is, they want to rebuild their manufacturing sector. So the US is like, pressuring other countries to invest more in their strategic sectors, energy and the shipbuilding, tech, auto, all other things. So the advanced countries in Asia, they are facing heavy pressure from the US. So in terms of the growth implication, we think that those countries which can handle these geopolitical tensions nicely, smoothly, then they can get benefit from this change. But other countries, if they don't successfully handle these US pressures, then in terms of their growth implication, they may see their potential growth slowing down further.
Yeah, okay, got it. And yeah, I would say that's a related topic to one other chapter which we wrote on trade and supply chain realignment, which we argue in the report is happening slowly but surely. And we see that particularly in countries like India and ASEAN in terms of supply chain shifts. That's being seen in sort of firm level surveys, also on data on FDIs, as you said, but also on intermediate goods trade within the region. And then, yeah, but as you say, the motivation is very clear. MNCs are really trying to not just establish supply chains to get tax incentives, to benefit from tax incentives, but they're becoming cluster driven in the sense that they want to be next to their suppliers and in countries where there is great connectivity and great logistics. So on that front, we are seeing the big winners on supply chain shifts as India and Malaysia in particular. That said, there is another chapter on coping with China shock 2.0, where we are arguing that the shares of China's shares of global exports will continue to rise and would raise concerns about competitive pressures and disinflationary forces to trading partners across the region. And these sectors are led by sort of the well-known new three, EVs, lithium batteries, and solar panels. But in that list, we've added things like construction machinery and shipbuilding in China, both of which will be strong competitors to countries like Japan and South Korea. And then lastly, I'd say for the rest of the region, we have a vulnerability scorecard to this shock, which we have constructed. And based on a few different metrics, the losers would be Indonesia, Thailand, and the Philippines because they're most vulnerable to that shock. Chetan, on that topic, you also contributed something on the equity markets and the implications. Which sectors are the big beneficiaries from China's rising global export shares?
So I'd say you've been within the new three sectors. We think the clearest equity market winners can be found in EVs and batteries, including energy storage systems, which are called ESS, where we think sector growth is strong, companies are growing and expanding overseas, and margins are also positive. However, for the solar industry, while China has some of the world's largest and most competitive companies, overcapacity has been a major concern. So if you look at, let's say, prices of polysilicon, solar wafers, solar modules, these prices have started to decline again following a brief rally that we saw late last year when China introduced some anti-involution policy. So that just suggests that overcapacity is still a problem for the solar supply industry. In fact, I would also add and say that some of the major solar companies in China actually reported net losses in 2025 because of these industry-wide price compression. Now, shipbuilding is another interesting industry. China increasingly dominates incremental global capacity additions across commercial shipbuilding. We think China's key advantage beyond labor costs lies also in financing, steel integration, and also delivery speed. And I think that's how China is gaining market share. In the heavy construction machinery, which is another sector that you highlighted, our thinking is that the sector benefits from lower pricing as well as China possessing some of these integrated supply chains. So overall, I would say from an equity market standpoint, the natural winners for anyone who's looking for opportunities should be Chinese listed companies that are expanding revenues abroad and or expanding footprint outside China. And one can find a lot of these companies that we've also highlighted in this report.
Yeah, and that's, of course, partly because Chinese domestic demand is soft, but they could export more. Okay, Craig, back to you. There is a chapter as well on developed market rates, which could stay higher for longer. What is the impact of that on markets in AEJ over the medium term?
Yeah, look, this rise in DM rates, it's very clear that the impact on Asia rates markets and FX markets is growing. We are seeing, I'd say overall, like negative balance of payments pressures emerging on the back of this. And we've seen this historically as well in our analysis. I would say within Asia space, Southeast Asia are the ones that really are more at risk from this, Indonesia, Philippines, India. Specifically on the rate side, it's probably two things. One is you're seeing this energy price increase, higher rates because of this. BOP pressures kind of demand a higher term premium in some of these markets. And of course, in terms of the short end, markets have shifted quite significantly towards pricing in hikes as well. Like for example, Korea, India, I think there's probably now around 60 basis points or so of hikes priced by the end of the year. On the FX side, I do think that it's similar countries, currencies which are going to get affected. Indonesia rupiah, Philippine peso, India rupee. But the first reaction we've seen is intervention coming through the reserve drainage. I would say beyond this, just I think we need to be a bit more careful. Obviously, there is going to be the risk of rate hikes coming through for some of these countries, if not already. But then beyond that, obviously, some risks of capital controls or policies that are very unfriendly to investors. That is a risk ahead. I would say overall, Indonesia stands out to us as most vulnerable. And then followed by Philippines. India is less vulnerable, but nonetheless, the BOP pressures are particularly high at this point in time.
Okay, great. Thanks, Greg. Now let's try and summarize things and draw overall market implications, taking into account everything that we've done in the report and all these shifts that we've mentioned here. So, Sonal, could you maybe summarize the countries that will come out overall as winners versus those that might struggle in Asia as the region rewires itself?
Yeah, Yuban. So I think, as everyone's discussed, there's actually a lot going on in terms of structural shifts in the region, and we think this is going to have an uneven impact. So the winners potentially, in our view, include China, Malaysia, South Korea, Australia, and Singapore. We see these as beneficiaries across many of the shifts we discuss in the report. So AI or energy security, or an alternative to the US dollar. In contrast, Philippines, Thailand, and Indonesia, we think, may struggle the most. They have a high vulnerability to the China shock, to higher energy prices, and limited gains actually from the trade realignment. I would say, though, Asia and Asian policymakers and companies, they are not static. And so these rankings can change depending on how countries adapt in the coming years.
Okay, great. And Craig, I guess over to you. Any thoughts on the currencies which could outperform, underperform in that backdrop?
Yeah, absolutely. So outperformers, in our view, will be renminbi. Obviously, there is some diversification in terms of the trade settlement argument that we talked about. I would say also the overall balance of payments is extremely strong. It's highly competitive, and all of this in terms of renminbi appreciation already is happening with the dollar still holding relatively stable. So the question is, if the dollar weakens, what's going to happen on that backdrop? Sing is going to be the safe haven status. We're seeing very strong capital inflows, and then underperformers, I would say Indonesia. And India. Indonesia, more because of the monetary and fiscal policy uncertainty, and I think that just goes beyond what's happening on energy price backdrop negativity, and on India, even if the dollar were to soften, I think the problem that would come through for those who are expecting rupee to appreciate would be RBI accumulating dollars. I think that would be a very strong trend that would happen.
Okay, great. Yeah, it sounds like broadly consistent with the winners and losers list that we have, Sonal mentioned. Finally, Chetan, on the equity markets, anything else to emphasize apart from what you've already mentioned before?
Yeah, I think the overarching message is that Asian equities are generally bifurcating, and we can see the divergence already playing in equity markets. So just like how Sonal said, there are countries which would likely do better, and we can see a similar trend playing out in equity markets as well. So our thinking is that Korea, Taiwan, China equities, they stand out as multi-theme beneficiaries, from AI production to energy security to defense spending themes. To an extent, Malaysia also benefits somewhat, although the challenge for Malaysia is that the listed universe is much smaller. And we think India equities sit somewhere in the middle as of now. And whereas on the other side, in contrast, we do think equity markets in the Philippines, Indonesia, and Thailand face the toughest combination. So I would just end it by saying that for investors, the differentiation opportunity in Asia is as wide as it has been for many years.
Yeah, and it's not just have or have-nots with the AI story. Okay, fantastic. Let's leave it here. Thanks again to all of you for sharing your insights. To our listeners, there are a lot more details in our report, some chapters on Japan, defense spending, and rare earths, which are also very interesting. So please check it out and feel free to reach out to us if you have any questions. Bye for now. Well, that's it for this special edition. Thank you again for listening to our podcast, edited and produced by John Dalton. Please like and subscribe to Nomura's podcast on Apple, Spotify, and SoundCloud, or your usual podcast provider. We'd love to hear your feedback, so please feel free to write a review and share this podcast to anyone you think might be interested. You can check out nomuraconnects.com for more of our research and updates. Bye for now.
In a complex and unpredictable world, where a sunset in one market means a sunrise in another, one investment bank always looks beyond the horizon to help our clients release the potential of tomorrow, today. Nomura, connecting markets, east and west.
Disclaimer. This content has been prepared by Nomura solely for information purposes. It is not intended to form the basis of any investment decision and is not an offer or solicitation of an offer to buy or sell or enter into any agreement with respect to any security, product, service, including but not limited to investment advisory services or investments. The opinions expressed in the content do not constitute investment advice nor is legal, regulatory, accounting or tax advice and may change at any time without notice. You should seek independent advice as appropriate for individual circumstances. For further information, disclaimers and disclosures, please visit Nomura Connects at www.nomuraconnects.com.